Investors buy growth stocks hoping that they will outperform benchmarks like the S&P and NASDAQ composite. In this video, we're going to talk about 3 top growth stocks that have the potential to do that based on rising revenue and rising profits, and they're in good industries. The first pick on this list is Supermicro. It is an AI infrastructure company that produces AI servers. It's a big partner with NVIDIA, and it's been in the news quite a lot. The stock went parabolic in January. It really hasn't been the same since it joined the S&P 500 in March 18, 2024. And it's been in a deep correction ever since that point. However, the guidance for fiscal 2025 was good with revenue, with the high point suggesting that revenue can more than double year over year. The issue with that earnings report that initially created a strong dip, a 20% drop after earnings was released, is that Supermicro expressed that profit margins would continue to narrow. This has been one of the main concerns with the investment thesis for Supermicro, but the reason that it looks like a good investment now is because of the overall negative sentiment for the stock has created a relatively attractive PE ratio. And if we look at net income, actually came in pretty good in the fourth quarter of fiscal 2024. It was up by 82% year over year. So even if that growth rate declines, which it's likely to do so, even if we're talking about 30% to 50% year over year revenue growth or something in that range, it's still a really good percentage. And Supermicro has expressed that they're going to resolve the margins and get them in a better place by the end of fiscal 2025. We also saw revenue increase by 143% year over year in Q4 fiscal 2024. And the company does have a tendency to beat its guidance. So it is possible that we see better revenue numbers than what the company is anticipating. A PE ratio in the 30s is definitely going to make the stock a bit more attractive compared to at the peak of its bull rally. We saw a PE ratio in the 80s. Now, there are 2 things that can stir up some more momentum for the stock that can lead to some quick gains. The first is NVIDIA's earnings report is coming up on August 28th. If that is a good earnings report, Supermicro is likely to rally alongside NVIDIA. Those 2 often move in tandem with each other. And the other thing is Supermicro is doing a 10-for-1 stock split quite soon. Stock splits have been a big hit in 2024. And it's likely that if NVIDIA reports good earnings, that's going to lead right into Supermicro's anticipated stock split, which can generate some strong momentum for that stock. The second growth stock on this list is Deckers Outdoor. This is the company that has Hoka, UGG, and a few other brands under its corporate umbrella. The stock has beat the S&P 500 this year and is up by close to 600% over the past 5 years. So it's been a really good buy and hold for long-term investors, but more gains can be on the way due to a few reasons. First is that Nike and other athletic apparel giants, they are slowing down, whether we're seeing negative year-over-year revenue growth or just year-over-year revenue growth rates that just aren't what they were a few quarters ago. There is a lot of slowdown in the industry. We don't really see this so much with Deckers Outdoor that reported 22% year-over-year revenue growth in the latest quarter, as well as 82% year-over-year net income growth. So it's growing, and it's doing so quite profitably. The profit margins are expanding nicely. Now, Hoka is the biggest part of the Deckers Outdoor brand, and that component was up by 29.7% year over year. It makes up more than half of total revenue. So when the largest segment of the company is also growing at the fastest pace, it suggests that revenue and net income should both continue to grow at a good clip. Now, one of the weaknesses with Deckers Outdoors was the Sanuk brand. This is the worst performer in the Deckers Outdoor portfolio, but the company decided to sell it recently, and that's going to free up more time and capital for Deggers Outdoor to commit to some of its other ventures, such as Hoka, such as UGG. And it also has this other brands category that's up by 124% year over year. It's a small percentage of total revenue, but selling the Scenic brand, that gives Deckers Outdoor more flexibility in where they focus their time. The company has a 6-for-1 stock split coming up, which can create a lot of momentum leading up to that stock split. And the company certainly has a financial performance and tailwinds to support that momentum. Duolingo is the final stock on this list. The returns year to date aren't that good, but the company has long-term catalysts and growth rates that suggest it can become a winner for long-term investors. The company gamifies learning new languages, and it's also expanded into subjects like math and science. The format has worked very well with retaining active users, attracting them, and converting them into paid subscribers. Daily active users in the second quarter reached 34.1 million individuals. That's up by 59% year over year, while monthly active users came in at 103.6 million. That is up by 40% year over year. Now, these aren't the people who pay, but they do watch ads. Some of these ads are promoting the Duolingo membership, while others are the traditional paid ads in which they're getting paid based on how they view the ad and how they click on the ad. Now, the company, though, it has 8.0 million paid subscribers. That figure is up by 52% year over year. And a lot of the daily active users, they're seeing the ads quite often, and they're more likely to become the paid subscribers, which allows Duolingo to generate steady recurring revenue. And not only are they generating good revenue, we saw that again with 41% year-over-year revenue growth in the year-over-year in Q2, but net income in the second quarter of 2023 was at 3.7 million, and in the Q2 2024 earnings report, we saw a net income of 24.4 million. So the profit margins are soaring quite quickly, and we are still seeing some strong top line growth, which suggests the PE ratio is going to be a bit more reasonable in the future. The company is still growing at a fast pace. It's still attracting users at a good pace, and it's converting them from free to paid at a fast pace as well. So even though Duolingo doesn't have the best year-to-date performance, especially if we're comparing it to other stocks on this list, it has the catalyst and the potential to become a long-term winner for investors. These are the 3 growth stocks in this video. Make sure you subscribe so you get more videos just like this one, and I look forward to seeing you in the next one.